Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO Founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul continues his conversation with Alan Scharfstein, CEO of middle market investment banking firm, the DAK Group, focusing on finding the true value of a company beyond traditional financial metrics.
Last time we were talking, we were talking about the disruption danger or opportunity, depending on how you look at it, in the economy these days. And it was interesting, subsequent to our conversation, a report came out by, I think it was one of the big four, but I can't remember exactly, but a report came out indicating that one of the biggest concerns, if not the biggest concern of CEOs, frankly worldwide, was what they call the Uberization effect, which is obviously referring to Uber, meaning competitors coming in from sort of out of nowhere that wouldn't even seem to be in your industry and causing disruption. Uber obviously being more of a technology company more than anything else, and it's disrupting the transportation world completely. I guess then the question becomes, how does that translate into value creation and how one measures value creation and the value of companies, particularly middle market companies, going forward. And obviously it can be looked at from two perspectives. It can be looked at from a company that wants to grow and perhaps insulate themselves or be aggressive about innovation, hence being an acquirer perhaps. And it can be from a company that is more defensive or, trying to capture their value at the right time and being a seller. I mean, there's a couple ways of looking at that, obviously. So you have a nice statement regarding value, regarding the value of a company. It's not what it's worth to you; it's what it's worth to them. And I think that's a good place to start.
Okay.
Would you maybe expand on that a little bit?
Sure. In today's world, as business owners look at their businesses, the way in which they understand or assess the value of the business has changed. Traditionally, business owners looked at businesses and said, the business is worth to me some sort of multiple of earnings, multiple of EBITDA, some sort of metric that was internal to the business. And that was the way the business owner assessed the value of the business to him, and that's very often the way outsiders, potential purchasers or investors would look at the value of the business to them. Today, that's all changed, because today the value to the acquirer can be, and very often is, very different than what it is to the business owner. And so as a result of that, business owners have to be a little bit more insightful, look a little bit more broadly at the value of their business, because if they don't, they may well be leaving dollars on the table by simply looking at it as a traditional multiple of earnings.
Maybe if you could expand on sort of your view of what the non-financial metrics, the non-financial indicators are that are driving value these days.
Okay. Well, yeah, there are a lot of non-financial values that are driving, that appear to be driving the value of businesses. But very often those, if you really look behind them, they have real value and financial implications. And what I mean by that is the following. When a buyer is assessing the value of a business, they are doing an economic analysis in terms of what that business will contribute to their bottom line.
Right.
And that value may be very different than what it is to the seller. So, for example, a buyer may be able to take a look at a business and say, through our distribution system, we can add significant value by pushing this product through our distribution system. A buyer may look at a company looking at acquiring and saying, we have additional products that we can distribute through that buyer's existing distribution system, and therefore significantly increase the contribution or the value of that business to us. A buyer may take a look at the technology that a company owns and said, that company may not be fully leveraging or taking advantage of that technology, but we are able to do it, and we are able to monetize that. So you put those various factors together, and the value of your business or a particular business may be worth a lot more to the buyer than it is to the seller because they have different economics. The challenge that one has when one is looking at this as a potential seller of a business is that the buyer has a significant knowledge advantage over you. They understand what the value of the business is to them and what value it can drive to them and what they can afford to pay for the business. You as an owner of the business, as a seller of the business, may not have that same knowledge, and as a result of that, may not be doing the correct analysis, may not understand the value to them, and therefore risk leaving money and leaving value on the table.
And I guess it ultimately kind of boils down to, at least from a seller's perspective, it boils down to the difference between a financial buyer, a private equity group, or what have you, which is really has a different kind of model. Although perhaps not. In the case of a roll-up, there would probably be a similar analysis. But a purely financial buyer is going to have a certain set of objectives, as opposed to a strategic buyer, presumably another company, that wherein what you're saying really becomes crucial because they're buying you for a reason that may transcend just pure number dollars and cents, as you said, broader distribution channels, perhaps better technology, perhaps that they want to leverage, all those kind of things. It kind of comes down to that differential, doesn't it?
Well, I think what it really says is that as an owner of a business, when you look at who the potential buyers for your business are, you have to look at different buyer groups and understand what the advantage of each of them are and how they make their decisions. It is often seen that a private equity firm will approach a business owner who is not on the market, and that business owner has a real challenge. If the price that is being put on the table appears to be fair, do they move forward with that? Do they run a broader process? How do they make their decisions so that they end up making the right decision? And for most business owners, this is a process they've never gone through before. They aren't familiar with. And as a result of that, sometimes they make decisions that may not optimize their value. Now, one of the things I think you mentioned, Paul, was that private equity firms very often act as financial buyers. Interestingly enough, in today's world, in approximately 50% of the cases, we see private equity firms really acting as strategics because so many companies are owned by private equity, and so many of them are now using add-ons as a way of building value that very often they can act as strategics and have the economics of a strategic buyer also.
Right. Yeah, particularly for the add-ons, right? Yeah. I've been speaking with various vendors of certain types of software that are designed to help companies assess their value from a very broad list of drivers, some of which are purely financial, some of which are operational, some of which are strategic, some of which are related to employee culture, the whole bit. There's this sort of whole list of drivers that and it basically takes these things basically take data from a gazillion acquisitions and try to create kind of a window into what your value is right now relative to your industry, and potentially here are the things you can do to increase that value, and they try to quantify it. Now, I don't know how robust those are. I can't speak to that, but it does speak to the issue of having operational issues, and I think you've pointed out before, a part of that value, and perhaps a large part of the value of a company, comes into play with respect to your operational efficiency, your people, as you pointed out, technology, and your ability to change. I suppose what do you are those things sort of crucial in terms of maximizing your value?
Yeah, they are. Clearly, a company is worth more than its financial statement or its balance sheet may show. And one of the things that we certainly look at is when you look at a given industry, that industry has its typical average metrics for business transactions. And some of the engines that you talk about may take a look at those and say, for a given industry, the multiple of EBITDA ranges between 6 and 8 times, between 4 and 7 times. They have some broad statistics like those. But there are two questions that really raises. One is the question of when there's a business that sells for a multiple of 4 times EBITDA and one that sells for 7 times EBITDA in the same industry, why does that occur? What is it? What are the inherent characteristics that's going to drive a business to sell for a premium over another in the same industry? And we look at those various factors. As a matter of fact, we have a tool that we use called the DAK Value Index, which assesses a number of these subjective factors, such as the company culture and its receptivity to change, such as issues like customer concentration and various risk factors like that. And we look into all of these various factors that tend to drive a valuation towards one side or another of the existing numbers within the industry. But the other thing I would say is that as much as we are good at this and we understand these factors, I would tell you that there are still major variances that occur out there in the real world, because it's almost impossible to understand what the fit of a particular business is with a particular buyer. If a buyer needs a business, if a buyer needs penetration into a market, if a buyer needs to get into a given geography, if a buyer needs a given technology, we can break all the rules. You take a look at a lot of the great deals that have been done out there that people are talking about, be it the technology deals, when Facebook acquired Instagram. You take a look at those deals and you say, can they justify those based on the economics? And the answer may be not apparently, but smart people sometimes figure out that what any of these acquisitions do is they give them a window. They give them an entree to a market they could never get on their own. It gets you speed to market. These are all factors that the only way you're going to know about them is to really engage in discussions between a potential buyer and a potential seller, and be smart enough to understand what the real value is to the person on the other side of the table.
Be sure to check back for the conclusion of our interview with Alan Scharfstein of the DAK Group. Thanks for listening.